SCHD is one of the best dividend ETFs ever created. That's exactly why most people never question how they use it. But here's the problem. SCHD is optimized for simplicity, not for maximizing income growth. And that difference matters more than most investors realize. In this video, I'll break down how SCHD actually works, why its simplicity hides income inefficiencies, how it stacks up against other dividend ETFs, and how a small structural change can dramatically increase long-term dividend growth. And in the end, I'll show you and Josh how this one adjustment can turn SCHD from a solid hands-off income ETF into a portfolio that can double its dividend output from $1,800 per month to $3,200 per month over time. To understand how income gets doubled, you first need to understand what SCHD is built to do. SCHD follows a strict rules-based system. It selects U.S. companies that have paid dividends for at least 10 straight years. Then it filters for financial strength, cash flow, balance sheet health, return on equity, and dividend consistency. That's why SCHD works. You're owning businesses that have already survived recessions, inflation spikes, and economic slowdowns. Companies that keep paying shareholders even when markets get uncomfortable. This is what makes SCHD such a strong long-term income foundation. But here's the part most investors never look at. SCHD doesn't look at valuation in the way most people think about it. It doesn't ask whether a stock is cheap or expensive compared to its history or its fundamentals. If a company passes the dividend and quality screens, it stays in the fund at whatever price the market assigns to it. That means inside SCHD, some holdings are reasonably priced, some are stretched, and some are sitting at discounts, all blended together. When you buy SCHD, you buy that entire mix at once. That's intentional. It keeps the ETF simple, diversified, and easy to hold without constant decision-making. The trade-off is that SCHD gives you the average result of those holdings, not the best possible one. Prices move faster than businesses do. A strong dividend company can fall out of favor for reasons that have nothing to do with its cash flow or its dividend. SCHD doesn't respond to that, it just holds. You don't have to. That difference is where the opportunity shows up. Prices and business value don't always move together, even inside an ETF like SCHD. Once you notice that gap, it becomes easier to see how income growth can be pushed further without abandoning the ETF itself. This is where the opportunity actually comes from. SCHD owns high-quality dividend companies, but once they're inside the fund, it treats them almost the same. Markets don't behave like that. Prices move faster than fundamentals. Interest rate changes, short-term earnings disappointments, sector rotation, and plain investor emotion can push solid dividend companies well below their long-term value, sometimes for years. The business doesn't break, the dividend doesn't disappear, but the price drops anyway. When that happens, SCHD doesn't lean in. The ETF keeps holding the stock, but it doesn't buy more of it relative to the others. From SCHD's perspective, nothing has changed. From an investor's perspective, everything has changed. That same dividend is now coming from a lower price, which means higher yield, faster future income growth, and better long-term compounding. This is where passive investing leaves money on the table. Owning SCHD by itself means accepting the average outcome of all 102 holdings at all times. Cheap stocks, expensive stocks, and fairly priced stocks all blended together. That keeps things stable, but it also limits how much income growth you capture. The opportunity isn't outside SCHD, it's inside it. It's the moments when high-quality dividend payers inside the ETF are temporarily mispriced, and SCHD's rules force it to stay neutral. That's where an intentional investor can step in, not to replace SCHD, not to speculate, but to selectively lean into value or dividend while keeping SCHD as the foundation. And that naturally leads to the next question. If this is the setup, how does SCHD really compare to other dividend ETFs that claim to do it better? When you line SCHD, DGRW, and SPYD up side by side, the differences become obvious pretty fast, and they explain why SCHD works so well as a core holding. SCHD is trading around $29, charges a rock-bottom 0.06% expense ratio, and pays dividends quarterly. Its trailing 12-month dividend rate is about $1.05, which translates to a 3.6% yield. That yield isn't just solid, it's roughly 32% higher than the median ETF yield. More importantly, SCHD has delivered a 10-year dividend growth rate of 10.61%, nearly 70% above the median, with 14 straight years of dividend growth and dividend payments. That combination of yield and growth is hard to find. On the price side, SCHD isn't built to be exciting, but it's held up well. Returns have been around 3.74% over the past year, roughly 32.78% over 5 years, and around 132% over 10 years. Under the hood, the portfolio leans into cash-generating defensive sectors, with about 20.57% in energy, 18.16% in consumer defensive, and 15.54% in healthcare. The fund holds 102 stocks, and the top 10 make up about 40.59% of the portfolio, which keeps it focused without taking on extreme concentration risk. Now compare that to DGRW. DGRW trades closer to $90 and carries a much higher 0.28% expense ratio. It does pay dividends monthly, but the yield is only about 1.4%, almost 50% below the ETF median, which is why it earns a D+ yield grade. Dividend growth has been uneven, with weak short-term growth and only 2 consecutive years of increases. Inside the fund, about 27.09% of the portfolio sits in technology, which explains why long-term price performance has been strong, with more than 214% growth over the past 10 years. With DGRW, growth clearly comes first and income comes second. SPYD sits on the opposite end of the spectrum. It yields about 4.35%, roughly 60% above the median, with a dividend rate close to $1.96 and a low 0.07% expense ratio. The trade-off shows up over time. 10-year price growth sits near 55%, and dividend growth has been inconsistent. The portfolio is heavily tilted toward real estate, financials, and utilities, with almost no exposure to technology, which explains both the higher income today and the weaker growth based on compounding long-term. This comparison explains why SCHD sits in the sweet spot. It doesn't chase the highest yield like SPYD, and it doesn't prioritize growth at the expense of income like DGRW. It balances yield, dividend growth, and quality, keeps costs low, and sticks to disciplined screening. That balance is exactly what makes SCHD such a strong core holding, and why it works best as the base of a strategy rather than the entire plan. Because even though SCHD is stable, it isn't risk-free. It just carries a different kind of risk than most investors expect. One of those risks is sector concentration. SCHD leans heavily into energy, consumer defensive, healthcare, and financials. These sectors produce steady cash flow, which supports dividends, but they don't lead every market cycle. When technology and high-growth stocks take over, SCHD tends to lag. That's not a flaw. It's the natural result of choosing income over momentum. Another pressure point shows up when interest rates rise. Higher rates makes dividend stocks less attractive in the short term, so money often moves toward bonds and cash. Even when SCHD's underlying businesses are doing fine, prices can still soften. SCHD has handled these periods better than many high-yield funds, but it doesn't avoid them completely. Then there's the less obvious risk, opportunity cost. SCHD spreads money across its holdings and doesn't respond to valuation extremes. That keeps swings smaller, but it also means the fund won't add more weight when a strong dividend company becomes a better investment option. Over long periods, that neutrality can slow income growth compared to a setup that's more intentional. These are structural risks, not quality risks. SCHD holds financially strong companies with long dividend histories. The businesses aren't the problem. The rules are. In the end, I'll show you and Josh how one adjustment can turn SCHD from a solid hands-off income ETF into a portfolio that can double its dividend output from $1,800 per month to $3,200 per month over time. We need that adjustment because SCHD is designed to be consistent, not adaptive. It won't lean into opportunity, and it won't step aside when conditions change. That's what makes it dependable, and that's also where its limitation comes from. The objective isn't to eliminate these risks. It's to design around them while keeping SCHD at the center. To do that, you need to understand how SCHD behaves across different economic cycles, because that behavior shapes how income grows over time. Looking at SCHD through actual performance data makes its behavior much easier to understand. During market downturns, SCHD has historically been less volatile than the broader market. Its beta sits around 0.75, which means it tends to move less than the S&P 500 when markets fall. Over recent years, its standard deviation has stayed in the mid-teens, lower than growth-heavy ETFs. Prices still drop during corrections, but the declines have usually been smaller and dividend payments have continued. When markets start to recover, SCHD often rebounds faster than many people expect. As conditions stabilize, money flows back into profitable companies that generate steady cash. That's where SCHD's fundamentals show up. Its roughly 33% total return over the past 5 years hasn't come from expanding valuations. It's come from dividends and steady earnings growth, which tend to recover earlier than speculative growth. During inflationary periods, SCHD's sector exposure helps a ton. More than half of the portfolio sits in energy, consumer defensive, healthcare, and financials. Many of these businesses can raise prices or protect margins, which supports dividend growth. That shows up clearly in the data. SCHD has maintained a 10-year dividend growth rate of about 10.61%, allowing income to grow faster than inflation over long periods. Where SCHD struggles is predictable. In strong tech-led bull markets and rapid rate hike cycles, performance lags. That's the trade-off for lower volatility and income reliability. SCHD doesn't dominate every cycle. It delivers durable, repeatable results across all of them, which is exactly why it works as a long-term core and why strategy matters more than timing. So instead of fighting those cycles, the smarter move is to build a powerful strategy around it. That's where the core and satellite strategy comes in. The core and satellite strategy is not about replacing SCHD or taking more risk. It's about changing how your capital is distributed so income grows faster over time. Instead of putting 100% of your money into SCHD and accepting the average outcome of its rules, you keep SCHD as the foundation and then intentionally overweight a small number of its strongest components to accelerate dividend growth. In simple terms, SCHD stays the engine, the satellites act like fuel additives. So, 70% of the portfolio remains in SCHD. That core delivers exactly what SCHD is designed to deliver: diversification, stability, low volatility, and dependable income across market cycles. With a 3.6% yield, a 10.61% 10-year dividend growth rate, and roughly 9.22% annual price appreciation, SCHD does the heavy lifting and controls risk. The remaining 30% is allocated to selected SCHD holdings that show stronger dividend growth or favorable income characteristics. This is the shift from passive ownership to deliberate positioning. In Josh's SCHD 2X portfolio, that 30% is split evenly across 3 stocks: Interparfums, ticker IPAR, American Financial Group, ticker AFG, and T. Rowe Price, ticker TROW, each at 10%. IPAR brings income growth to the portfolio. Its current dividend yield is 3.24%, paired with a 10-year dividend CAGR of 20.16% and 11.21% annual price appreciation. The yield isn't high up front, but the growth rate materially accelerates future income and drives long-term compounding. AFG contributes higher current income with a 4.32% dividend yield, 12.23% 10-year dividend growth, and 6.65% annual price appreciation. It strengthens cash flow without sacrificing dividend growth. T. Rowe provides yield stability with a 4.81% dividend yield, 9.34% 10-year dividend growth, and 4.71% annual price appreciation. It supports income consistency and portfolio balance. When these pieces are blended together, the effect becomes clear. Even with SCHD still making up 70% of the portfolio, the combined portfolio yield rises to 3.76%, and the overall dividend growth rate increases to 11.6%. Long-term price appreciation of the portfolio lands around 8.71% annually. The final piece is how dividends are used. Income from SCHD, IPAR, AFG, and TROW isn't spent. It's reinvested back into the portfolio, increasing the number of shares owned. Over time, this creates a compounding loop. SCHD provides stability, satellites increase income growth, and the growing income base buys more shares. Now, let's see how this portfolio compares to investing only in SCHD. Let's compare both of them. Let's say Josh invests 10 grand into each portfolio. First, one portfolio holds only SCHD. Then the second uses the upgraded portfolio so we can see the difference. In Josh's SCHD-only portfolio, the early years move slowly. In year 1, the portfolio value sits just over 11 grand, and annual dividend income comes in around $400. Progress is happening, but it feels modest. By year 10, the portfolio grows to roughly $34,000, and projected annual dividend income rises to about $1,000. Compounding starts to show up here, but it still isn't doing most of the work. By year 20, the change becomes clear. The portfolio value is projected to reach around $122,000, while annual dividend income climbs to approximately $5,000. At this stage, the portfolio begins to feed itself, with dividends playing a much larger role. By year 30, the portfolio value is projected to grow to roughly $464,000, and annual dividend income approaches $22,000, or about $1,800 per month. Now compare that with Josh's core and satellite SCHD 2X portfolio. In the early years, the projections look almost the same. In year 1, the portfolio value is projected to sit around $11,000, with annual dividend income again around $400. By year 10, the portfolio is projected to grow to roughly $34,000, and annual dividend income reaches about $1,000. Up to this point, the two approaches appear nearly identical, which is why structure often gets overlooked early on. The separation starts after that. By year 20, the portfolio value is projected to reach around $130,000, while annual dividend income rises to approximately $7,000. This is where reinvested dividends and higher growth rates begin reinforcing each other, and the curve starts bending upward faster than in the SCHD-only portfolio. By year 30, the portfolio value is projected to grow to roughly $589,000. Over time, that changes. By year 30, the core and satellite portfolio is projected to generate about $43,000 in annual dividend income, or roughly $3,600 per month, compared to around $22,000 from the SCHD-only portfolio. Same starting investment, nearly 2 times the income. The same pattern shows up in portfolio value. By year 30, the SCHD-only portfolio is projected to reach around $464,000, while the core and satellite portfolio grows to roughly $589,000. Nothing here comes from timing or taking extra risk. Both portfolios ride the same market. The difference comes from structure. Early on, it barely shows up. Over time, it completely changes the outcome. Want to know how to make $6,000 a month in dividends with just $25 a week? Click the video on screen to find out.